Hello, hi, good morning. Um, so thanks very much for coming along today and welcome to our capital modeling webinar. Our discussion today is going to be a release of our results from our market survey, which we conducted into capital modeling in the general insurance industry here in the UK. I just wanted to run through, before we get stuck into the survey and into the webinar itself, I just want to run through a couple of housekeeping points, just how to use this webinar to those of you who are new to this. So on the right hand side of your screen, you'll find some controls there where you can ask questions to the panelists, to the three of us here today, and you can do that at any time. And we'll try our best to pick up questions as we go along. If not, there will be a question and answer session towards the end of our discussion of our talk today. The other thing I need to mention is that this webinar is being recorded, and we will distribute the webinar to all of the attendees that were here today. And if there are any sort of interruptions, technological issues, or anything unexpected that happens, I apologize in advance. You know, there are always little gremlins running around, but we hope to make sure that today's webinar runs as smoothly as possible. So with that, thanks again for your for your time today, coming along to hear us speak. And I also want to say a special thanks to all of the people out there who've participated in our survey, who's responded to our survey questions. You've really helped us to get a good piece of work out to you, and it's been a really, really interesting analysis. And without you, obviously this survey wouldn't exist. So thank you very much for that. And for everybody else, we really do hope that you find our survey today helpful and insightful and useful. In our discussion today, we're going to run through the sort of headline results from our analysis of the market. But we do, it'd be nice to flag to you that these aren't all of the details that we've managed to capture. We do have a very comprehensive report that's going to be released very shortly, and that will be on our website. And also at some point we'll try and get a recording of this survey out onto the internet. So anybody who wasn't able to attend today, it'll be a resource there that you can watch in the future. And I think with that, let me do a quick introduction of who the presenters are. I'm Bharat Raj, and I'm a general insurance actuary and a senior member of our general insurance actuarial team here in Grant Thornton. I've been at Grant Thornton maybe about 7 years now, and in that time I've covered quite a lot of capital modeling work across the industry, certainly a lot of internal model validation, and more recently a fair bit of model development work with a number of capital modeling platforms that we license. And I would also like to introduce the other speakers that will be speaking today. So I'll hand over at this point to Anu to do a quick introduction.
Thanks, Bharat. Hi, everyone. I'm Anu. My full name is Anurupa Bose Dhingra. I work for Grant Thornton as a manager. I've joined Grant Thornton a little over a year now. And I've been doing a variety of projects, a lot of capital modeling and model validation as well. My background is in capital modeling. I have around 10 years of experience in capital modeling, and before Grant Thornton, I was working for a capital modeling team for a personal lines insurer. Vaibhav, if you want to go ahead.
Thanks, Anu. Yes, hi guys. I'm Vaibhav. I work with the Grant Thornton actuarial team as an assistant manager. I've worked on a lot of capital models, and I have roughly 4 years of experience in the general insurance industry. Prior to Grant Thornton, I've worked with other consultants, and mainly my experience has been in the consulting side of the actuarial industry. So yes, looking forward to this webinar. I'll hand over to Bharat now to talk over the talking points that we have today and the areas that we're going to cover as a part of this webinar. So Bharat, why don't you enlighten
Thank
us?
you. Yeah, thank you. Thanks, Vaibhav. So I guess I'll start with a quick recap of what we asked our participants in the survey, and maybe a recap of the questions that you helped to fill in for us. We explored sort of generally the size of teams and the sort of workload that capital modeling teams are facing. We also talked a little bit about the common technological platforms that people are using. So it's modeling software, how many simulations you run, how often you run that model, and so on. We also then explored a few different topics which will be interesting we thought will be interesting to capital modeling teams. So model change was one of the areas that we explored, model validation, and some of the new emerging areas that are relevant to capital modeling teams, so IFRS 17, Brexit, and climate risk modeling. How we'd run through the presentation today, I'm going to cover the first 2 or 3 bullet points there that are in front of you, up to the team size and workload. Then I'll hand over to Anu to cover technology and model change. Vaibhav is going to talk about model validation, IFRS 17, and Brexit, and then I'll close off the discussion today with a bit of a little bit on climate risk modeling. So if we can have the next slide, please. Thank you. So just a quick recap of who's responded to the survey. We've got a really good mix in terms of the insurers and the individuals that replied to our request for this survey. So that's been a very good mix between Lloyd's managing agencies and non-Lloyd's entities. So as you can see, the percentages there are 44% of respondents were managing agents, about close to 50% were non-managing agents. So just the PRA regulated, if you like, general insurance companies in the UK. We've also had a number of composite insurers respond. These composites, although they have life and non-life entities within their group, we did ask very specifically for the non-life insurance part of their group to respond to this. So hopefully these results are reflective of the general insurance side of the picture and not necessarily sort of going across the piece in terms of the insurance industry. A good mix in terms of the role of the individuals that responded as well. So by and large, most of the people that responded were in some way related to the actuarial function or the capital modeling function. So 33% of our respondents were head of capital, which is expected. About 19% were chief actuaries or the head of the actuarial function, and then 19 and 15% respectively were either other actuarial team members or members of the capital modeling team. And finally, we've also had about 15% respondents coming from the risk management side of the business. So if we can have the next slide, please. And here we want to show you a picture of the mix of the companies that responded to our survey, just in terms of their premium volume and in terms of the size of their balance sheet, so the net technical provisions. And really, the story here is that it's quite a good mix. We've managed to represent smaller companies with less than £100 million worth of net premium or less than £100 million worth of net technical provisions, and some very large companies with premium volumes and technical provisions exceeding 2 billion. Now, there are certainly much larger companies than 2 billion. We've just sort of grouped them together, and it just so it presents fairly easily. But the picture here is that we've hopefully got a really representative cross section of the UK insurance industry. Moving on to the workload and the size of the capital modeling team. So this is one of the areas that we wanted to explore in our survey. How busy are capital modeling teams? How overworked or underworked are they? And how well are they really coping with various demands that are put onto them? One proxy that we've used here to sort of judge the amount of work that a team is doing is the number of legal entities that that particular team has to service from a capital modeling perspective. And as you can see, the first graph there on your left, that's really a snapshot of how many legal entities each team has to service, and we've also got a comparison. So in the dark purple bars, those are the results from our 2022 survey, and in the lighter purple bars, those were the results from when we asked the same question in 2020. Those were the results from that survey. So we've got a view over time as well as to how that picture is changing. One thing that did jump out at us is that the number of companies out there which service only one legal entity, that's dropped since the last time we've ran this survey, and that drop has corresponded with an increase in the number of companies that have 2 legal entities or 3 legal entities. From what we've seen, we believe that this is probably driven by Brexit, as in a lot of companies had to split their operations between a UK and non-UK elements, especially for their European business, which had to be moved out of the UK, which essentially meant that there's a new legal entity there to be assumed under their processes, and in some cases there have been more than one entity as well. So that's why you see that corresponding increase in the number of people that have 2 or 3 entities, and a drop in the number of companies that have just one entity that they look after. And the other charts there, the other categories there, they're relatively consistent. The other thing, so looking at the second graph on the right, that's just a measure of the size of capital modeling teams. The thing to note here is that there has been generally an increase. So we can see that increase in the size of teams. So in that range of 6 to 10 people in a capital modeling team, that's increased quite significantly, and that's really offset by the number of people that had less than 5 people in the team, 5 or less people in the team. In the larger categories, teams of 11 to 15 or over 15, there's a little bit of movement there, but given that the sample size is getting quite small, we haven't really read too much into that. But generally, the story here is that there are more people in capital modeling teams, and that's not necessarily surprising given all the sorts of activities that we've seen in and market events that we've seen between 2022 and 2020. So we had COVID, for example, which was in no small way a small event. It did create quite a lot of additional work, additional model runs for modeling teams, and certainly there's been quite a lot of regulatory pressure to produce results and produce more frequent analyses, which is all sort of contributed to that need for more resource in teams, and adding to that Brexit impact of there being slightly more legal entities that teams are servicing now in the market. Again, that's then put some pressure on headcount and resulted in an increase generally in headcount. So if we can have the next slide, please. So what we wanted to show you here is really some way of trying to normalize that and and get a market view and something that's consistent and comparable across insurance companies. So to do that, we've essentially just used the information in the last two graphs that were in front of you, and looked at the number of team members per legal entity as this measure. We've run this survey. This is our third time now, so we've been able to track these results since 2017 when we first ran it. And as you can see, that middle line, that's the average number of individuals per legal entity. And that's showing us consistent story here that between 2020 and 2022, there has been a noticeable increase in that average. And we believe that the reasons for this is number one is COVID, and number two is more legal entities that people are having to work on. We did calculate some percentiles, so the upper and lower quartiles of this. They're fairly flat, but I think we do need to caveat that the sample size wasn't enormous, so it does give you some sense of where the ranges are moving. But there is a little bit of danger there in reading too much into those quartiles. But generally they're not inconsistent with where the average is trending. The average is definitely giving a picture of an increase in sort of resourcing and workload across the industry. So if we can have the next slide, please. And here, what we want to do is move on to the sorts of activities that modeling teams are busy working on, and the key areas that are where their resources are being deployed. And I'll run through each one of these categories one at a time. And I just wanted to point out on this graph again, we've got two time periods here that we're comparing. So in the darker purple bars, that's our results from the survey this time round, so 2022. And we've compared that to the same results that when we asked the same question in 2020, and we can observe how that's changed in these times. So the areas that have kept modeling teams most busy, parameterization came up highest. Model development and model change was number two, and the third highest was time spent on reporting modeling results and communicating of modeling results to other stakeholders and to senior members of the company and so on. That's very reassuring. These are very value-adding activities. So modeling teams are doing things that are either improving the accuracy of their models or helping to embed the model results, or helping to use the model within the business, and also helping to improve functionality and user friendliness of models, and modeling speed and runtime and so on. And that's very consistent with the conversations that we have with our clients. That's certainly where we see people wanting to spend their resources, and it's reassuring to see that that is generally where people are managing to spend their resources. So that's a good story there. The other areas that modeling teams do spend a fair amount of time on, model validation has been a big area, and that's been relatively flat over the past 2 years, which is consistent with what we've noticed in the market as teams settle into sort of 3-year validation cycles. As validation has become very much business as usual process and models have reached some stage of maturity, it is really more of a steady state rather than testing a new unfamiliar model, and the workload there is really starting to settle down. Another area there that comes up where there's been a general increase in the amount of time spent is on data manipulation. We think that this is largely driven by COVID and by the fact that there are more legal entities again due to Brexit, simply because that's just more to service and more model runs to have to run, and that's just created a bit of a resourcing burden there. And documentation is again a big area where modeling teams spend their time. and that's been fairly consistent, fairly flat since the last time we ran our survey. So those were the areas I was going to cover initially. At this point, I'm going to hand over to Anu to talk through a couple of different aspects. So thanks, Anu.
Thanks, Bharat. So as Bharat mentioned, that I will be talking about a little more about the capital modeling platforms and the capital models themselves. So here we were looking at different capital modeling platforms and their market share among the respondents. And the market share of each platform from this time survey is then being compared to the 2020 survey. We see that Igloo and Remetrica are still the most widely used modeling platforms, though as you can see, Igloo, the market share of Igloo has dropped significantly since the 2020 survey. We also see that Tyche is gaining its popularity. So it was only the proportion of users using Tyche in 2020 was only 14%, whereas now it's 23%. So it has gained a lot of popularity, and actually it was only 0% in the 2017 survey. So there is a shift in the modeling platforms, but still Igloo and Remetrica still remains the popular ones. There are other platforms such as Excel, @Risk, or Risk Explorer, which some of the companies use, but it is fair to say that the dominant three platforms are Igloo, Remetrica, and Tyche. And among them, now it's kind of a fair split among the three of them. And it'll be interesting to see next time when we do the survey how things are. So if we can move to, yeah, thank you. So moving on to the number of simulations within the capital model for each model run. When compared with the results of our 2020 survey, we have seen an overall increase in the number of simulations performed by our respondents. So 80% of our respondents now basically run their model between 50,000 to 100,000, 50,000 to 200,000 simulations, while the remaining 20% actually run their model either on 200,000 or more simulations. And if you see, it is quite interesting to see that the proportion of respondents using less than 50,000 simulations has actually reduced from 18% in 2020 survey to 0% this time. So there is clearly a shift to using a higher number of simulation. Also, if you see, the proportion of respondents performing 100,000 or more simulation has increased from 41% in 2020 to 76% in 2022. Now, these increase in the number of simulation is basically because of the enhanced computing power, more efficient models, and faster modeling platforms, and because of which all the insurers are able to run a higher number of simulations, leading to a more stable model, more stable results, and yeah, faster models basically. If we move on to the next slide, thank you. So we asked the respondents, various insurers, on how often do they run their model to calculate the capital requirement. So when we look at the frequency of model updates compared to the previous survey, the frequency of capital runs has definitely increased a lot since what was the frequency till like last survey. So on the left, if you see, you'll see the regulatory model runs, the frequency of regulatory model runs, and on the right are the frequency of economic model runs. If we look at the regulatory model runs, the proportion of respondents running the capital model quarterly or monthly has increased from 29% earlier to 43% now. And the proportion of respondents running the model annually has actually decreased. You'll see a similar thing for the economic model runs, where actually the monthly frequency has increased quite significantly, but it is slightly offset by a decrease in the quarterly runs. Now, again, coming back to the same theme, that the insurers are able to do that because of enhanced computing power, more efficient models, faster running platforms, and faster modeling platforms. The insurers are able to run the model more frequently, as it takes less time and less resources as well. If we move on to the next slide. Thank you. So now we look at the model change and look at the various reasons for a model change and how the model change is as a process is embedded in the BAU process. And as Bharat had shown earlier, that model change is one of the activity that the employees are more engaged in. The employees spend a lot of time in that activity, one of those activity. So on the left, you see a graph showing the different reasons for the model change. 68% of our respondents said that they have made at least one significant model change into their capital model in the previous 2 years. The most common reason for a model change was to increase the model's functionality or sophistication. This was then followed by making improvement to the model's reporting capability. As we again earlier we saw that reporting was one of the activities where employees did were a lot involved with. And the third reason being that the implementing a model change platform. And as we saw earlier, that the market share of Igloo is slightly reducing, whereas Tyche is gaining its popularity. So that could be one of the reasons that they're doing a model platform change, or any, just to make things more faster as well. On the right, you see a graph showing the embeddedness of the model change process in the business as usual. 40% of our respondents said that the model change process is fully embedded in the BAU process, while 32% and 4% of our respondents said that their model change process requires some improvement or significant improvement. And the rest of them, 24%, basically they do it on a completely ad hoc basis, and they don't have an embedded process in the BAU as part of the BAU work. So this gives a picture of how the model change process is basically dealt with within the capital modeling teams. Now I will pass on to Vaibhav to talk a little bit about model validation.
Thanks, Anu. That was very elaborate. I think one of the interesting points to note was the increase in model runs. One interesting point to further investigate might be that whether this is because of increased automation or because of more constant monitoring by the management and the steering committees in light of changing dynamics due to the pandemic. All right, so moving on to the next bit, that's model validation, which has, in previous questions, I think, been the fourth most important activity after modeling and documentation activities in terms of average amount of employee years spent by insurance companies. Now, 96% of respondents say that they have a formal validation process in place, and the ones that do not have one usually use the Solvency II standard formula for calculating the capital requirements. Now, just to investigate on how the process of model validation is resourced by insurance companies, we see that roughly 96% of insurance companies have some internal involvement within the model validation process, where 52% fully undertake it in-house, whereas 44% have some internal intervention and use some support from external vendors or contractors. A very small percentage, that's 4% of our respondents, fully outsource their model validation process to external vendors or contractors. the owner of the model validation process in for most insurance companies happens to be the risk management function, although some insurance companies also tend to use their internal audit or the actuarial functions for their model validation process. Now, that being said, this might cause some independence challenges for those insurance companies that have their capital modeling teams and their model validation teams both report into the risk management function. Maybe move on to the next slide. Yes, so before we talk about the results, just to give a little picture about what this chart is trying to show us, it might get complicated sometimes. So the top bar over there, across any of the categories, the top bar shows the maximum response that we had. The top of the little box there is the upper quartile. The red dots are the averages across each of the categories. The bottom of the box are the lower quartiles, and the lower bar, which is not visible in the last two categories because it's 0, is basically the minimum of our responses. Now, talking about the approximate number of employee years required annually for model validation by different teams, our respondents, in line with our expectations, believe that the most amount of employee years are spent by their in-house validation teams. Now, this is in line with our expectations since we know that quite a significant chunk of our respondents do have formal validation processes in place, although they also believe that this is quite significantly complemented by a time and effort spent by the capital modeling team, which stands at roughly about half a year worth of employee years spent annually. They also believe that to support this, some support is sometimes catered to by the independent validation teams within the groups of insurance companies, or some support lended by external providers or firms standing at 0.29 employee years. Now, just comment on whether these numbers are likely to reduce in the future. I think some insurance companies do believe that more work can be done on model validation processes in terms of increasing the efficiency, increasing the automation, so as to derive more value add from the model validation process than it just being a tick box process. So top-down approaches are getting more emphasis, and they're really focusing the areas of work on the purpose that a capital model is built for, so that they can validate what exactly needs to be validated. All right, can we move on to the next slide, having spoken about the processes of model changes, capital modeling, and model validation? Talking about where else can we use the outputs that we get out of capital models. IFRS 17 is one topic that's been on the mind of most actuarial management teams. 52% of respondents said that they will be reporting under IFRS 17. Not a long time to go since its implementation. Of the 52%, 77% of the respondents believe that the capital model outputs will in some way or the other help in the IFRS 17 reporting processes, whereas 23% of the respondents, 23% of those respondents that report under IFRS 17 or will report under IFRS 17 believe that the capital model outputs will not really help them with the IFRS 17 reporting processes. Now, that being said, this is consistent with our previous year's survey, where 25% of the respondents that would report under IFRS 17 believe that capital model outputs would not help them in this process. Moving on to the next slide. What impact has Brexit had on capital models? I know this has come up a couple of times already in our talk before, but like we noticed in our mix of respondents, that those respondents with more than one legal entities have increased, and those with just one legal entity has decreased. Now, like we said, we believe this had something to do with Brexit, and we just tried to reconfirm that with this question. So how has Brexit impacted capital modeling teams? Roughly 40% of our insurers or of our respondents tend to cater to insurance business in both the geographies, UK and the EEA. As a result of Brexit, they would have had to add additional legal entities, thereby increasing the workload on capital modeling teams. And hence, it's the most significant impact that we see that Brexit has had on capital modeling teams. As a result of these added legal entities, the insurers would have had to effect Part 7 transfers. The capital modeling teams would, have increased workload in order to facilitate these transfers, in order to, affect the changes and impacts of these transfers on the capital requirements of all the legal entities, and probably some changes to the team structure as well. So we see that as one of the impacts of Brexit as well. Now, whenever there is such a structural change in, the structure of legal entities, and there's a Part 7 transfer, there's always a requirement to modify the modeling assumptions, the methodologies, and document those changes. Hence, 7% of our respondents each believe that there has been revisions to documentation and modeling assumptions. In light of data regulations between both the geographies, I think data sources have required significant modification as well. So yes, those are the main reasons, main impacts of that Brexit has brought along to the capital modeling teams. Having spoken of Brexit, what impact has climate change brought to capital modeling? I'll hand over to Bharat to talk more about this. Bharat, why don't you tell us what insights you have about this?
Right, thank you. Thank you very much, Vaibhav. Okay, so now we move on to climate risk modeling. It's just a very short section at the end, and then we'll open up to question and answer session after this. And thank you for those who have been contributing questions. I think there are a couple that are already on the list, but we'll continue to collect them and address them once we've got through the rest of the materials here. And there's not that much to go, really, not that much more to go, really, in terms of materials. So, okay, climate risk modeling. This was something that we're very interested in because we see this as a developing area, and certainly one area to look out for in the longer term. We do believe that capital modeling teams are going to be increasingly under pressure to have a good answer as to what are you doing about this, how are you capturing the risk, and are you sure that the actual SCR projection or any other analysis that you're using the capital model for is actually reflecting the changing risk environment. So our first question to survey respondents was, do you actually make an explicit allowance for climate risk in your model? We're surprised to see that only 16% of respondents said yes. We did think that this would be a higher percentage of people out there, but there you go, that is the actual result. The reason for this, we believe, is because a lot of insurers out there are allowing for climate risk, or believe that climate risk is allowed for implicitly in the capital model, or that the environment hasn't so dramatically changed that it needs its own separate risk module or its own special adjustment or additional calibration just for climate risk. It's already there, baked into the discussions and the parameterization and the assumptions that you're coming up with anyway. And then to some extent, the vendor CAT models, the natural catastrophe models are doing some work there to allow for climate risk as well. And of those respondents that did say climate risk is an explicit allowance in the model, we did try and probe that a little bit further to find out, well, how do you do that in your model? And the vast proportion of respondents have allowed for climate risk by simply in their natural catastrophe models, by modifying either the assumptions or the output from those models to take into account maybe higher frequency or higher severity of primarily weather-related events and things like flood and so on. The remainder of those respondents did indicate that they use other approaches. A popular approach is to just add a simple aggregate loading or some form of uplift on either the outputs or into some of the key assumptions into the model. And then another one there is to adjust the loss ratios. Again, just some sort of simple adjustment, maybe a loading to say, well, this is an allowance in case things change due to climate risk and we start to see deteriorating performance or conditions. So I think if we move on to the next page on climate risk, still sticking to climate risk. So the previous analysis there was very much what have you done in the past and what are you doing currently. This is looking forward to the future. So what do insurers plan to do about climate risk? Is this an issue that capital modeling teams are thinking about in the short term, in the medium term, in the long term? And again, the results here have been slightly surprising. So we asked this question to all respondents, not just the ones that allow for climate risk currently, so everybody who responded to the survey. And the results are slightly surprising in that almost 40% of people said that they do not envisage having to allow for climate risk even in the longer term. We see this area as potentially something like COVID. So before the pandemic, it was not necessarily viewed as an event that could have lots of secondary impact, which would be very, very material and very major to your business model. But actually, that's where a lot of the issues have been with COVID. So it's not directly as a result of novel virus that there were insurance claims or there were impacts on any performance of insurance portfolios. It's really then the market reaction, the social reaction, and everything else, the secondary sort of fallout from that event, which has led to a lot of the risk in insurance portfolios and the increase in either or the change in the profitability and performance of these portfolios. Slightly more reassuring is the fact that actually quite a few insurers do believe that climate risk is something that they need to allow for, and they are taking on the challenge to do that. So about 40% again are looking to do this in the next 12 months, so it's a fairly urgent issue. And some of these will be insurers that are catching up, so where they haven't already got an allowance, they'll be looking to make that allowance. So we do see that category dropping as over time, as you know, maybe if we repeat this survey in a couple of years, we expect to see that dropping as people have already implemented some sort of analysis for climate risk, and maybe also in the 38% where no changes envisaged, we do anticipate this to come down over time. And I think a number of other insurers have indicated that that's a longer term improvement for them, or maybe some enhancements that need to be done. And certainly this is an evolving sort of science and evolving area. So it's certainly one that you know, the work is not going to be done in the next 12 months. You do need to revisit this and keep an eye on it as it progresses. And the other thing to mention here is that it is not only getting a lot of attention from insurers internally, but this is getting a lot of external attention. So regulators are very interested in this topic, which will continue to evolve, and that interest will continue to change the sort of mindset and the approach of capital modeling teams, and also certainly investors and markets are taking an interest. So in the disclosures and in accounts, people are, or in SFCR documents, people are going to start to ask questions as to, well, what are you actually doing about this longer term issue? Is this something that you're well prepared for and you've quantified in the context of your own business model and your risk environment? Okay, so I think we'll stop there in terms of the run through of the materials, and move on to a couple of questions. The first question that I'll take the first one, which was when this is an easy one, is a rather housekeeping question. So when will the report be released? We're hoping to get this up on our website, or certainly circulated to all of the attendees today before the end of the week. If we do miss that deadline, apologies in advance. We don't think we will, but apologies in advance if we do miss that deadline by the end of the week. We'll definitely get it to you early next week at the latest. And beyond that, we do hope to have a web page up and running, which will have both a recording of, or link to at least a recording of today's session, and some access to our wider materials, so you can share that around with anybody in your team, or help to, or if that comes in useful as a resource in the future, it'll be there and it'll stay on our website for some time. There are quite a few questions on modeling platforms and vendors. So maybe if we can go back to the graph with the slide with the graph of, I'll tell you what slide number it was. It was slide number 10. Yeah, so question number 1 was, why is the Igloo and Remetrica market share dropping and the Tyche market share increasing? I think we have to be very careful in answering this question, because we don't offer any of these products. These aren't our products. We're simply doing a survey of the market. Can't really say, exactly the reasons why one's increasing, one's decreasing. Generally, we do see, an appetite for insurers that have been using one platform to try other platforms. There are certainly improvements that are being offered across the piece, and certainly this is also a signal of a maturity in the market. So as there are more established providers, the market share is going to reflect the fact that there's more choice out there, and naturally that will balance out over time. Tyche has been is a new entrant into the market, and it's been gaining ground. I think maybe initially there were some advantages on their platform, as it was a new platform, but certainly Igloo and Remetrica have responded, and they're catching up. So it remains a vibrant market, and there is healthy competition, we believe, from our perspective. And if anybody wants to jump in there and add, no?
I agree, Bharat, that basically Tyche is a new platform, and there's more choice. So some of the insurers would like to try that as well, and it's basically it's a new platform. So some companies have shifted, but Igloo still remains. It is well established, and Igloo still remains one of the top 3. So yeah.
Okay. All right. Another question from our audience today, and I think I'll pass this one to you, Anu. Do you have any thoughts on Aon and its acquisition of Tyche recently? So Aon, and the question also says Aon here is already owning Remetrica, and now it's acquired Tyche. So over to you.
Well, it's quite interesting, and when I read the news, it was very interesting to me as well that now Aeon owns two platforms, Metrica and Tyche. It There's not much that I can say, but let's see how they promote which platform is something that we'll look forward to, or what's the idea that they have going forward between the two competing kind of platforms, and how Igloo or Towers Watson react to that as well. It will be interesting to see, but yeah.
Yeah, I certainly agree there. I guess it's not clear yet, and I'm sure Aeon are not going to reveal to us what their longer term strategy is with the two platforms. Maybe they might choose to merge them, or they might choose to keep them separate. They certainly do have different market shares. Over time, there's a lot to be revealed and a lot to play out. Certainly, they have been quite distinct modeling platforms, but you can only imagine that there will be some crossover over time, and they will maybe learn from each other now that they're under the same roof. Okay, another question here that I've got from our guest today. In the current environment, there's a heightened sort of inflation is clearly on the way up. We're now entering a high inflation environment. How do you see firms responding to this and representing this risk in their capital model? And put that one, maybe Vaibhav, if you want to have a go at that.
Yep, thank you. So yes, definitely, I think inflation has been on the rise. How are teams planning on reflecting this in their capital models? I think they can always follow the trend, allow for the increasing inflation in the cash flows. However, I think the margins included, or the uncertainty embedded now in the outputs of the capital models, in light of whether this increasing inflation is likely to persist in the future, and if so, for how long. I think that adds some uncertainty, which impacts the outputs of the capital models. That's my 2 cents on it. But Anu, Bharat, any thoughts, additional thoughts?
Yeah, sure. I'll volunteer a few ideas here. I guess where we're seeing the response is really in the economic scenario generator calibration, and that's the obvious place to start. I guess the inflation there will still be some form of mean reversion in the ESG, and it will still. I don't think we've moved away from that concept of this is not a very long-term issue that will come back to some sort of normalized inflation after, at the most five to maybe 10 years in a very pessimistic scenario of high inflation. But there will be that mean reversion. Inflation at the moment is driven, and it is not the only view out there, but it is not by any means an uncommon view that inflation is driven by certain very select commodities. So food and fuel essentially, which is driving high inflation. At some point, housing and perhaps other critical sort of day-to-day items for individuals is going to see some inflationary pressure. But certainly in the short term, food and fuel prices are driving this high inflation environment. We haven't necessarily seen all of the strongest responses coming out of central banks in terms of monetary policy response or rate rises or anything like that. It's starting to happen. I think certain larger economies are starting to signal interest rate rises, but certainly nothing like was it the 1970s where we had sort of interest rates in double digits. So we've not entered an environment like that. I'm sure that in models it is within the suite of scenarios, but whether that's actually entered into the mean of the projection of models, we don't think it's there yet. But certainly, a very volatile area. Agreed that this is highly risky, and certainly some insurers out there would be thinking about putting explicit loadings in there above and beyond what's already in the ESG calibration, and then others would take a less dramatic view on that. Anu, did you have anything?
Yeah. I just was thinking about the parameterization process. So probably inflation will be reflected in that process as well. Like what we've seen is basically they do the inflation adjustment for historical experience, but it might need to be considered on how the parameters are reflecting the future as well. So in the parameterization, also in the business plan, it's the mean position, as you said, probably it's there in the it needs to be baked in the business plan, and it will be coming through the pricing teams into the business plan as well. So that is another way we will probably see some impact.
Yeah,
hopefully.
I agree with that. Okay, so there's another question here, and this one is talking about the validation process. And the question is for those respondents who their validation process is owned by the internal audit team, has there been any pushback from the regulator or from their regulator, potentially in terms of that reporting line compromising the 3 lines of defense model, and where there has been this pushback, how's this been, how they address the regulator's concerns? I think we certainly have seen, I'll try and take this one first, and then I'll pass it over to Anu and Beba for any additional comments. We certainly have seen model independence or validation independence being a very big topic for the regulator. So not just from that internal audit perspective, whether it's owned by the actuarial team, the risk team, or the internal audit team. The 2 questions that regulators normally do care about is there enough independence between the validation and the running of the model? And then the second question, equally important, is the model validation team got the necessary experience and the knowledge to give the model a very thorough challenge. So that's one of the areas that certainly from the internal audit team's perspective, demonstrating that they've got that modeling team experience or that modeling experience, the capital modeling sort of expertise, subject matter experts, either directly employed by the team or in some way reporting into that team. They need to be able to demonstrate that. In terms of compromising the 3 lines of defense model, generally the audit plan is the place to thrash out those issues. So ensure that from the companies that we speak to, where model validation is part of the activities undertaken by the internal audit team, and that does make it into the annual audit plan. It does go into the audit committee discussions. There is then very wide engagement with senior members of their board and non-executives to invite all of that challenge and to really demonstrate that as a leadership team, the company is comfortable with the ultimate model that they've adopted, and that there's not going to create any sort of internal conflicts, or it's not going to create any sort of compromise in terms of the analysis and the robustness of the challenge. I guess if anybody else wants to add to that one.
Nothing from me.
Okay, I think we've sort of run out of time now, but thank you very much for spending the time today. It's been really nice to have you here, and we really hope that you did find this helpful and our insights were valuable. Like I said before, we will get the results out onto a website. We will be in touch shortly to tell you how to get there and give you a link and all the necessary information. If you do have any follow-up questions, do feel free to reach out to any of us. Drop us a line. We'd be more than happy to discuss this further with you. And again, thanks very much for coming along today.